This trading strategy is real smart money. And before you roll your eyes, it didn't turn me into a Lamborghini owner overnight. What it did do was keep me consistently at break even while I emotionally sabotaged myself multiple times. The risk is tight, which means you're actually allowed to make mistakes and not instantly nuke your account. I've even recorded live examples in my Trading to Profitability series, showing how simple trading becomes when you actually follow your own rules. That video will be recommended at the end if you want to watch my journey. Now obviously, use this at your own risk. Trading is risky no matter the strategy, especially when human emotions are involved. And yes, you are the problem sometimes. Whoa, wait, me too. Relax. Without further delay, let's get into it. Today, we're using examples from top scalper Fabio Valentini, who has a ridiculous record of over 500% in the Robins World Cup, and Andrea Simi, an absolute OrderFlow demon. Both channels will be linked below. Go study them instead of gambling. Here's the breakdown. We have auction market theory models and we have PBD models. I'll explain this the way I learned it, simple. If you're confused, drop a comment and I'll either respond or make a whole video on it. What is the auction market? The market is literally just an auction. You have buyers or bidders and then sellers, and price, which moves based on who's more aggressive. If buyers want something badly, they bid higher, well, equals price goes up. If buyers disappear or want it cheaper, price goes down. That's it, no magic, no banks pressing a destroy retail button. Now let's talk about what happens behind the candles. Say an aggressive buyer wants 5 contracts. The price has resting sell orders, so it gets filled. Cool, new price is set, let's say 102. Another buyer wants 5 more, price ticks up to 104. But then a seller comes in hot with 10 contracts, price snaps back down to 100. And because a lot of traders are human, we get things like FOMO, where suddenly slams hundreds of contracts at once. And suddenly the candle looks like it drank a goddamn pre-workout and smashes through your dignity. Congrats, you now understand auction market theory. Now let's simplify this into something you can actually trade. Open fixed volume profile range. If you're broke like me, use TradingView, free, easy, but I'd recommend using deep charts. Now, mark your value area high, value area low. This is roughly 68% of where price accepts value, but we just round it up to 70. If price breaks out and immediately snaps back into value, that's called a failed auction. Translation, buyers and sellers said, nah bruh, that price sucks. Price returns to fair value. But if buyers or sellers overwhelm the other side, we get expansion. Big candles, strong continuation. For valid breakouts, price breaks out, pulls back into or just above value, continues higher. Stop loss stays tight, targets are external highs or liquidity, high win rate, clean RR, and no hero trades. PBD models, just easier. This part is just simple. It's either a big P or a big B. That's it, that's the model. When I didn't understand value areas, especially in the chopping market, this is how I memorized them. No shame. PBD is basically AMT, but easier to spot. Your 2 main trades are failed auction, trade back into value area, or a strong breakout, where it pulls back into value, but then continues towards the upside. Stop below the last low, target the next high or liquidity. Now this would be done if I didn't trade it live, right? Exactly. I record my live trades, full transparency, wins, losses, and moments when I question my life choices. And if this works even when I suck at trading, then clearly the edge is real. All you need is patience, time, and the ability to not overtrade like a complete maniac. Oh my god, I suck. That's it for this video. If you're confused, leave a comment. I'll help. Thanks. Bye.